All right, it has been a while since I've done a video, and as usual, I don't have a script. I have no intention of editing this video, and my apologies in advance if I bounce around a little bit. So, in the last video, I talked about price structure, and today I want to continue that conversation specific to actually taking some trades. Again, I focus on the NASDAQ futures, the NQ and the MNQ, which stands for micro E-mini. Um, but everything I'm talking about is going to apply to equities and possibly crypto, but I have zero experience looking at charts of crypto. But I have to imagine that it's somewhat similar in that price travels from level to level. So price seeks out supply and demand, and you can quite easily see that on a chart. So let's start going through that a little bit. And the first thing I'm going to do, let it open up. Let's just open up. This is a 5-minute chart. I'm going to take some of these studies off because they're probably just going to confuse more than help. Okay, so we'll take all that color off, and I will take off this so you don't have all these arrows, and we'll get rid of the drawing set. Okay, so this is the NQ, the NASDAQ futures chart for today. For the US session. So futures trade 23 hours a day, starting at 1800 hours Eastern Standard Time or 1700 hours Central Standard Time, and they flow all the way through until 1700 Eastern Standard Time the next day. So there's a full 23-hour session in the NASDAQ futures market, which unlike equities, has advantages depending on, no matter where you live, no matter what time zone you live in, and no matter what your work schedule is, if trading is a part-time endeavor for you, the futures market, specifically the ES and the NASDAQ, provide opportunities for you to trade the markets um, in conjunction with doing whatever else that you're doing in life. So in my case, I'm a full-time trader and I choose to trade different sessions depending on what's going on in the market. But obviously I try not to trade 23 hours a day because it makes for a rather bleak life sitting in front of screens for lengthy periods of time. But you can choose the sessions that make sense for you. So you have, in this particular case, just a bit of a, this is not price structure related, but just sort of talking to you about um, just the market. So, in just general terms, you have, the Asian market. When the Asian traders come on, you have the London traders come on, and then you have the New York session start. So you have these three distinct sessions. And actually, the colors that you saw on my screen before, if I open up this is going to show you these are the sessions. So you can see Asian session in orange, the London session in green, and the New York session in blue. And you can see that they obviously overlap, right? You know, the Asian session overlaps with the London session, and the London session overlaps with the American session. So during my regular trading hours, I have these up because they are meaningful to me. Um, but for the context, for the purposes of this video, let's just focus on pretty much a blank chart. So let's just clear these boxes. All right, so the only thing that I have left up is the opening prints for each section, for each session, I should say. And this session right here, this orange session, is the Asian session. Okay, so all we're doing here is looking at how price travels. It's seeking out supply. And so, which is why when you look at a chart, you can see that price seems to revisit levels that it has revisited before. So, and obviously it's not to the penny, all right? Trading price movement is sometimes to the literal penny or to the tick or to the point. But you have to give it a little bit of leeway. So in this particular case, you can see here that um, we have price revisiting. All right, that's not by coincidence. We have price revisiting. Right, it visits, it visits, it visits, it visits, and finally it fails. All right, so this particular area as a new trader, you want to be identifying where buyers and sellers have accumulated, okay? Which is essentially you want to be looking to see where orders are accumulating. And it is very clear that there is demand, so that there are a lot of buy orders and stop orders sitting at here at this level. In the same way that there are a lot of orders sitting up here because it continuously rejects, okay? It's rejecting up here, which is similar to the day before. So if we look at the areas that it rejected yesterday, it was not able to revisit and push beyond these levels. And today we had a pretty decent downward day. And that means that supply, so the sellers, supply was overwhelming demand, the buyers. And you can you can clearly see that. So when you look at a chart, it doesn't matter what the time frame is, but when you look at a chart, you want to be looking to identify areas of supply and areas of demand. Because in trading, in order for prices to go higher, they need to go lower and they need to pull in orders. So they need to revisit levels, right? They go down, up, down, down, and up. And what they're doing here is think of it as a fire, all right? You've started a fire in the fireplace and it's burning bright. And over time, the fuel, the logs that are in the fire are starting to burn down. The fuel is diminishing. So how do you get the fire to re to increase? You restoke it with more wood. Okay, so think of it as price action needs to restoke itself with fuel. And what it does is it collects fuel in those demand areas and in those supply areas. And it travels from level to level, which is why you're seeing these areas, right? What you're looking for is, as a trader, you're looking for deterministic systems in a chaotic environment. And what that means in plain English is you are looking for patterns within what appears to be a chaotic environment. And a price chart for um, NASDAQ, for futures, or any price chart that represents price, if you stand back and you start to look for supply and demand on various time frames, whether that's daily, weekly, monthly, or on an intraday basis, it could be as low as 30 seconds, it could be as high as 4 hours, whatever time frame works for you. And obviously, I recommend that for example, if you look at in my world, in the way that I trade, my day-to-day screens are daily, 5 minute, 10 minute, 15 minute, and 30 minute charts. And I have some indicators that give me information from the hourly and the 4 hourly chart. So the goal, though, is to keep it as simple as possible and to start looking for patterns. Okay, so that's today. Let's look at these 2 days. Okay, you can see here that we had a high here. Okay, you can see that price visited it, visited, visited. visited, visited, visited. This is not by accident, all right? You can see here that in general terms, price flowed along this band, right? It's very clear. This is tradable. So what appears to be chaotic, all right, when we take away the drawings, what appears to be chaotic is in fact deterministic. So there's something called the random walk theory in in the capital markets, and anyone who well, actually forget the random walk theory. There are people who say that the market is entirely random. And my answer to that is if the market is totally and completely random, then how is it that these patterns are repeating themselves every day from day to day to day? All right. How is it that price topped out here and topped out there? How is it that we have a band of supply here, and if I extend it, it also acted as supply here? How is it that if we have a band of supply here, that it also acted in general terms as a band of demand, sorry, here? So, I think that there's no point in arguing it, but from where I stand and as a trader, and I make money every day with this, there is order within the chaos. And so as you start looking at charts, all that you're looking for, and this is, it doesn't have to be more complicated than this. Obviously, there is a lifetime of learning ahead of you as you embark on a trading journey, on educating yourself around trading. Okay, so it is obviously more complex than simply than the way I'm presenting it today. But if you can look at a chart and understand supply and demand levels, then you are already ahead of most and you can make money. You need to understand risk, right? You need to understand that if you take an order, if you take a long position, just get rid of this. You need to understand that if you take a long position there, you have to size yourself and as a function of your risk. So if you were to take a position here and you were to risk here, then obviously then you have to, you trade with the size that allows you to respect whatever dollar amount of risk that you're looking at. But if you are someone who understands how to calculate risk as a function of dollars and size, and you know how to identify supply and demand levels, then you already have a pretty strong basis for trading and generating profits from those trades. So the other thing that I will say is, yes, the capital markets, in my opinion, are deterministic within the chaos. However, it's important to note that trading is a game of mathematical probabilities. You will not have a 100% strike rate or a win rate. Okay, that it is there's no trader on the planet that has a 100% win rate. And so what that means is that whatever the playbook is that you use, whatever the edge is, right, whatever system it is that you're trading, let's say that you are trading a system that has you here, for example, here, this is the London Open print. Okay, so let's say your system has you purchasing um, retracements and pushes off of the London Open. Okay, so you have to understand that it would have worked here, no problem. It would have worked here, but it would not have worked here. Okay, So in this particular case, out of these three trades, you've got a 66% win rate, right? So that means out of 100 trades, this is, so I'm being way oversimplifying this, but out of 100 trades, 66 of them would be winning and 34 of them would be losing. So you are embarking uh, on a, well, you're taking on a profession, you're wanting to work in a profession where you are wrong X percentage of the time. All right. And that's really important to note. Okay. So, which is why risk management is more important than anything. Get that into your head. If you think that you're going to show up as a trader and treat risk as a secondary or, you know, some, if you're not going to prioritize risk management, then don't bother. Because if capital preservation in trading is your first goal, your first goal is not to win. Your first goal is not to have a fancy system. Your first goal is not to have all sorts of fancy indicators on your screen. Your first goal and your most important priority is capital preservation. And the only way that you can achieve capital preservation is by managing your risk. That means that if you say that you are willing to lose $1,000 on a trade or $100 on a trade, whatever it may be. If you're willing to lose X, that means that when you take a trade, your maximum exposure, because you've used a stop loss, is X. Okay, so if it's $1,000, that means that if you get stopped out, if the trade goes against you, you don't lose more than $1,000. And that is exceptionally important. It means that you use stop losses, stop loss orders. You never enter an order naked on the risk side. Okay. It means that you do not move your stop lower if your trade starts to go against you. Okay. Because now if you've moved your stop, all you've done is widen your risk. So if you can respect risk management, if you understand risk management, maybe I'll do a video on that, then what you're doing is you're protecting your capital. If you don't have a seat at the table, you can't trade. I mean, that's the bottom line, right? It's no different than playing cards professionally. If you don't have a stake in terms of money, you can't play. You can't play cards, you can't trade. So again, going back to the chart, what you're looking for is you are looking for obvious signs of supply, so overhead levels and demand. Okay, so let's remove those. Okay, so for example, today, um, as I said before, these these are how, these are one way that I identify supply and demand levels. These are the open prints, which means that these are the first price that got transacted at for the Asian, the London. So sorry, orange is Tokyo, green is London, and blue is New York. Okay, so these are the prices that were printed at the times that these sessions opened. So those are important to me. And if you go to the day prior, you can see that here, let's just bring this down. And let's just add this. For some reason, my automated session plot is not plotting the Asian. Okay, it's not drawing it across. Anyways, so you can see here that um, the the Tokyo print, the London print, and the New York print, all they all identify the levels of supply and demand. All right, and that gives me a little bit of a reference point. This gives me a reference point. I look at the high from the day prior, okay, and I see how price on this day reacts to it. Okay, came up here and failed it. So what am I doing? I'm going short because what price has shown me is that it was unable to continue any higher. The buyers simply weren't there. The supply here overwhelmed the buyers, and it headed further south. And where did it stop? Down and around this level. Okay, so right away I have targets. Okay, I have targets for entries and I have targets for exits. Now my job has been way simplified. Okay, so let's just make this a bit bigger. My job has been way simplified. And that's what you're looking for as a trader. Okay, and then your job is to if figure out, okay, well, if price is gonna, here's a rule. This is an important rule for me anyways. This is how I trade. An overhead level is supply until proven otherwise, so resistance, okay? So this level here from the day prior is resistance until proven otherwise, okay? A level below is support until proven otherwise. And proven otherwise, a poke below a level, and then it fails to really move, and then it comes back. This line, this demand level is still intact. Okay, so a level above is supply until proven otherwise. A level below is demand until proven otherwise. That's important to remember. Okay, so when this printed and held, okay, so when the London Open printed and held, this to me is demand, is support. Okay, there's two ways of looking at it. So demand and support are the same, and supply and resistance are the same. Either you can use them interchangeably. So the London print price opened, closed above it on a 5-minute candle, and then moved up. When it came back down here, I go long because this level is a level until proven otherwise. When it came down here, now it's set a lower high. So this is telling me, that it's weakening, okay? It came up. Again, this is just visual. Trading is all visual, okay? Price came up, bounced, came up, but it set a lower high. It was not able to move up and beyond the prior high. So to me, it's weak. I am not longing this. I may not be shorting it right away, but I'm not longing it. Okay. So this is it. A level above is supply or resistance until proven otherwise. A level below is demand or support until proven otherwise. Okay. So here we have, today we opened, see, look, okay, so today's London print, we opened and immediately closed. We closed below it. We meandered around. We came back to it, visited it. And the reason that we did this morning is because there was the non-farm payrolls data release. And this spike is at 8:30 Eastern Standard Time when the NFP was released. And so that's why you have this squeeze, okay? They were able to squeeze all of the shorts that were in it, brought it up here, and ultimately just failed back below. So I didn't touch this trade until it broke below this here, okay? Because we had support, we had support, we had a higher low, and this is the NFP. But when price came through here today, that's where I went short. Okay, and then from 701, we had, this was a 363 point move. Okay, and so in the NQ, every point is worth $2, so that is $726 per contract if you were to stay in it for the entire way down, which, obviously you no one's perfect. So, um, but this is what I look for. That's all I look for. I look for price structure, right? Which means that I'm looking to see where is price, where is candle structure showing me that there's going to be a turn, a reversal in sentiment at a level. Okay, and obviously the price, let's just put up a higher time frame chart. Look out here. This is a 30-minute chart. Okay, now today is particularly obvious. This is a 30-minute chart. All right, we failed down, support, support, support. We pushed on the NFP. If you know a little bit about candles, this doji is a high probability reversal candle. Okay, and we came back down through the level, and that was it. So if you were trading off of a 30-minute chart, you would have been short up here, or through, sorry, as it came back through the low and through this level. If you were trading a shorter time frame chart, you probably, well, you, in my case anyways, I was short through this lower level, only because I missed this particular setup on the 30-minute chart, but that's okay. Um, so what you're looking for is you are looking for breaks of supply and resistance, support and resistance. Okay, so the levels that I've been showing you so far have been, if we go to the 5-minute, the levels that I have been showing you so far have been a bit more macro, right? They've flowed from one day to the next, and certainly, or over multiple hours. Okay, but you, you don't have to be. Let's look at it here. Okay, this here, that high, that's a level. Okay, this low here, that's a level. You're looking for breaks of supply and demand. Don't forget, this is a 30-minute chart. So this is 30, each of these candles is 30 1-minute candles, or 6 5-minute candles, or, you know, so on and so forth. 3 10-minute candles. Okay, this is a level, all right? This is a level. Every time, look, you think it's by accident that price failed through the low of this candle, kept going, and on the next candle came back up here and rejected, right? A level above is supply until proven otherwise. A level below is demand until proven otherwise. Here, you had a demand level. It stopped here. But when this flipped, when this level got failed through it, it then became supply. And look, it came right back up here. So guys that I work with, if they weren't short already, or they were short, this is where they were adding, or this is where they were taking a position. They were looking for that pop. And then we came into a bit of a consolidation zone. Now this consolidation zone is still 428, is still 100 points. Okay, so it's easier to trade this on a little bit of a lower time frame. Although again, this doji is a very strong reversal candle, and that's a decent long right there. 452, it's almost 100 points. Okay, so I'll show it to you on a lower time frame. So here, actually, where is, let's just show you. So get in the habit of what you're doing is let's say, let's just look for this. Okay, so we've got this zone here. I just want to see it on a 5-minute. Okay, so there's that zone, all right? So it's a bit easier to trade. It's a bit easier to see the turns on in this type of PA, but you get the idea. Okay, this is great price action. If you know where to look for supply and demand, so here's the top of the range box is supply, and the bottom of the range box is demand. There are range traders that's what they trade. They just trade the top of the range to the bottom of the range, and back up to the top, and then back down to the bottom, and then back to the top, and eventually they know to look for a wash. Now this was a long time, this range, but it's a 100-point range, which is beautiful for a range trader. Okay, so, and here's that candle. Here's the candle that came back up and failed. This is also a very strong signal that the price is just, it's done. There's no sudden reversal to the upside on a day like this. So what I would say is it's important to really educate yourself around candles, around the use of candlesticks. It doesn't have to be hyper complicated, but you need to know what, in general terms, what are the revert, like what is a hammer, what is a doji, what is a spinning top. Um, and there's so many resources out on the internet, on YouTube for that, that I'm not going to get into it. Just doesn't. I'm just going to be duplicating what's already out there. And in the comments, maybe I'll post the name of or a couple links to videos that I think are really useful. So let's just get rid of these drawings. Okay, so back to the actual placing of trades. So the first thing that you're doing is you are looking, let's just keep it simple and don't go back further than a day. Okay, and look at the daily, right? So like if we look at the daily chart, sorry. Okay, so here's the daily chart. Okay, here we go. Okay, so here, so just draw your, put your lines on your chart. Okay, there's supply and there's demand. Okay, you don't need to make it more complicated than it needs to be made. All right, supply, demand. Price broke this a multi-day level and flushed. Okay, doesn't have to be more complicated than that. And then when it's flushed, you say to yourself, well, where is it going to go? Well, okay, well, so here is a possible target. Here, so all I'm doing is drawing a line at the lows. Here is another possible target. Okay, and if on Sunday night when we open up, we get a continuation flush, then these lines will be on my charts. And then obviously there's all I'm doing is I'm drawing lines. I'm just drawing where price is going to visit. We know that there's orders. We know that because long traders have position stops below here, below here, below here, below here, and below here. All right. If long traders took an entry on this day, or they're going to have placed their stops and they're going to just continuously move them up. So as price moves down to collect fuel, it's triggering those stops, which further fuels the downward movement until they just run out. Okay, which is why typically nothing just goes straight down forever. We come down, we go up, we come down, we go up, we come down, we go up, we go up. This is how you know prices move in a bit of a stair step manner, like up, consolidate, up, consolidate, up, consolidate, up, and now we've started back down again, right? And this downward trend, even if it continues for another couple of days, it doesn't go on forever. There will be a reversal to the long side, even if it's just, coming up. Like let's say we come up, oops, sorry. Let's say we come over, we come up, down, up, and then we come down again, and we just keep, like this is, who knows what's going to happen? We don't know. But the point is that get an idea. First, take a look at the daily chart. Okay, it's a 2-minute exercise. Where are the supply and demand levels? All right, it's not rocket science. Look at the opens and look at the highs and lows. Open, close, high, low. Okay. In this particular case, because we're on the downside today, I'm just looking at the lows, unless the candle's particularly far away, in which case I'll look at the open, or at the open and the low. Okay, so get an idea, not get an idea, identify your supply, your daily supply and resistance levels. Okay, so those are your more macro levels. Okay, so now okay, so those levels, I'm just going to clear them. Okay, and then you'll come to the daily and take a look. Like, let's look at the 30-minute chart. Okay, we know that we had, sorry, we know that we had some support there, right? We know that we had, in this particular session, we know that we had overhead supply right there. right? It's pretty straightforward. Like it really doesn't need to be complicated. Okay. Um, I mean, that's just from today's session. And then on a smaller time frame, if you move down to the down to 5 minutes, you know, you can see that you had topping out here, but that would have been difficult to see. It's just a couple of candles. But you can see that they're looking at these lines. Okay, these are the open lines. Like I said, opening print for Tokyo, um, London, and New York. And there's an indicator on TradingView that draws these automatically. And if you're a think or swim user for charting or trading order execution, then I have something for that as well, which I'm happy to share. Just ask me for it. Okay, but it really doesn't need to be more simple than that. So your goal is to identify. So this is your goal. Educate yourself around the use of candlesticks and candlestick patterns. Okay. Ideally, you want to be looking at the reversal patterns and you want to get a sense and you want to understand what a large candle means. Like, what is a bullish engulfing candle? What is a bearish engulfing candle? You want to know what the significance of a doji is, or a spinning top, or a hammer, or a hanging man. Okay, that's about it. That's really all you need. You don't need to go into all the complicated patterns. And the other thing, and then so educate yourself around candlestick structure and the use of candlesticks. Then start practicing identifying levels of supply and demand, so support and resistance. Okay. And just start plotting them on a chart and go back and look at hundreds of days, do hundreds, literally hundreds and thousands of charts. And so that you'll get better and better at it. And pretty soon you'll be able to look at a chart and you'll very quickly be able to identify what are some obvious levels. Okay. Um, and then the third thing is under you have to educate yourself around risk management. So now you get to a place where you're thinking about actually taking a trade. So you're looking at this chart, okay, you've let's say you've added your lines, and now you're saying to yourself, DMAC, what do I do now? Where do I take a trade? Well, if you subscribe to the idea that a level below is supply or demand until proven otherwise, and a level above is um, supply or resistance until proven otherwise, then you are looking to take a trade off of those levels. Okay. Now, this particular setup here was tricky because this is NFP. Okay, this is the non-farm payroll data release, so it's unusual. So maybe it's not a great idea, but in a case like this, it set a level. When it came down here, you would go short, you would go long, excuse me, and you would your risk would be just below the line that you are claiming is support, right? Because if it fails this line, then your thesis has been invalidated. So it's it there's no magic, there's nothing magical that's going to appear on your screen and tell you take a trade here. Okay, it comes down to you taking the trade based on your ability to read a chart and how price is moving in relation to levels. So what I will say is this: you don't want to be taking trades mid-range. Okay, so like you've got a level here and a level here. All right. So all this stuff, this is just mid-range trades. It's really easy to just get chopped up. You want to be taking, you want to be, oh, shoot, sorry. You want to be taking trades at the levels that you have identified. Okay. So we're going to put that back and we're going to put this back. Sorry. Okay. You want to be taking trades, you want to be going long in demand, and you want to be going short in supply. Okay. Now, as you educate yourself around candlestick structure, you will see that this doji is meaningful. And in conjunction with this level, it's very meaningful. And the same down here. Okay, so we had a bit of this, we had this range setting up, and this doji here is meaningful. Now, this may look like nothing on the chart, but that's almost 100 points. All right, it's not to be sneezed at. Again, quasi doji, right? These are oftentimes reversals. Okay, so that is 931, 888. That's 50 points, 45 points. Okay, from there to there. It doesn't look like much because we're on a 30-minute chart, but that's where you want to be taking trades. If you can get it into your head that you want to be taking trades at the outer limits, meaning at supply as for shorts and at demand for longs, you will go a long ways to keeping your risk tight, which means that you can use larger order, right? Someone who has a 100-point stop is going to be using less size than someone who has a 10-point stop. Why would you want to take a trade that has excessively wide risk? It's stressful and it's costly and it limits your upside potential if the trade works in your favor because you are sized for a 100-point risk, right? Someone who has a 10-point risk has 10 times the size than someone who has a 100-point risk, all things being equal. So you want to be focused on taking orders at the levels that you've identified as being clear demand or support. And obviously, I highly recommend starting in a just to get used to whatever platform you're using. Start with a sim, just start in sim. I don't recommend staying in sim for very long because at the end of the day, there is no substitute for trading than trading with actual money. But start in sim and you can get a trading view account for, I don't know, maybe $9 or $10 a month. That's an easy way of placing trades in a sim, or perhaps you have a broker that has a simulator. But like I said, get used to it in terms of order execution, platform knowledge, getting some confidence around your trading style. And but I wouldn't stay in there for too long. Maybe spend 2 to 4 weeks in sim, and then I really do recommend starting to actually place trades with live money in a live account. Because the I'm a believer that trading, it's from a mechanical point of view, from a technical point of view, is relatively straightforward. It's the mindset that gets in the way. It's people's egos, it's their fear, it's their stubbornness, it's their relationship to money. It's did they not sleep well? Did they have a fight with their boyfriend or girlfriend? Or did the kids keep them up all night? Are they stressed financially? Whatever it is, those those impacts on mindset are usually the biggest hurdle in trading as opposed to the mechanics of trading, right? Price moves from level to level. Um, the only two real indicators, true indicators, are price and volume. And if you have a real good understanding of all of those things, so supply, demand, structure, um, and how to read a naked chart like the one in front of you, you can trade. But you're going to always be fighting what's going on between your two ears. So I'm going to leave it at that. I think that's enough for today. Enough rambling from me. But if you have any questions, just pop them into the comments or shoot me an email. My email is dmactrades at gmail.com. So it's my username at gmail.com, and I'm happy to help where I can. So I will wish y'all a good day and or a good evening wherever you are in the world, and thanks for listening.